Hello and welcome. My name is Austin if you're new here, and I'm a certified financial planner practitioner. On this channel, we help educate you on complex financial planning topics. If you like this video, give it a thumbs up and subscribe to our channel for more helpful content. This is part 3 in a series on asset allocation, and we're going to review different types of investments and why some might be better than others for your investment strategy. We're going to talk about types of mutual funds, ETFs, individual stocks and bonds, and different investment strategies. Let's start with mutual funds. Mutual funds are a basket of stocks or bonds which give you exposure to hundreds or sometimes thousands of companies with just one investment. So you could have a mutual fund that covers one sector of the market, like just technology stocks. It could cover one category of the market, like the entire US stock market. Or you could have an all-in-one mutual fund that has total market exposure to stocks and bonds all in one mutual fund. Mutual funds have different strategies. Some have an actively managed strategy, and some are follow a passively managed strategy, or also known as an index strategy. Actively managed mutual funds have a fund manager or a team of fund managers on the back end of the mutual fund who are actively trading the stocks within the fund to try to outperform the index. So they're picking and choosing stocks from the index itself, like the S&P 500. They may choose 150 stocks out of there that they think are going to outperform the index over a certain period of time. An index fund, it just tracks the index. When the index goes up, your investments go up. When the index goes down, you follow the index and it also goes down. Actively managed funds tend to have higher expense ratios than index funds do. And again, with performance, sometimes active outperforms and sometimes index will outperform. It just depends on the company and the type of investment you're choosing. ETFs are very similar to mutual funds. They're also a basket of stocks. They're mostly index. There are some that are actively managed ETFs, but mostly index. And they track what the index does. The difference is that ETFs, or exchange traded funds, will trade intraday in the market instead of at the close of business. Mutual funds, you can just buy in once per day at the close of the business day of the market, and the ETFs will trade throughout the trading day. ETFs also have a lower barrier to entry. Some ETFs may trade at $50 or $100 per share, just like a stock does. So you could buy one share of an ETF at that price, whereas a mutual fund, the minimum investment may be $1,000 or $5,000 just to get initially into the mutual fund for the first time. If you're going to use individual stocks or bonds for your portfolio, you just kind of have to ask yourself what your investment strategy truly is. ETFs and mutual funds are much more diversified, so you're going to get hundreds or thousands of stocks and bonds in one investment in some cases. In an individual stock, if you chose something like Apple stock or Amazon or Coca-Cola, you would really have to, in order to get true diversification benefits, you'd need more stocks and bonds to get a similar result as just purchasing one ETF or mutual fund. So you need to get your large cap exposure, your US or international. So you have to balance all the right sectors and subsectors of stocks and bonds to get the same result as maybe a mutual fund or ETF. So that's something to consider with individual stocks and bonds. I hope this has been helpful learning about this a little bit more. Thank you for watching. If you have any questions on what you learned, click the link in the description to learn more about our firm and how we can help.